Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. There were two big news stories in the course of the last week. One, of course, being the US election, where Donald Trump, having survived that assassination attempt, was formally nominated as the Republican candidate for the November presidential election and moved further ahead in the polls as question marks remained over whether or not Joe Biden will be the Democrat candidate. And also at the end of the week by the dramatic outage which crippled many airlines and ruined the weekends of many travellers and office workers. A warning perhaps of the dangers of a cyber malfunction, though cyber terrorism was ruled out as the explanation. Shares in CrowdStrike, the company whose software caused the problem, fell during the week. But perhaps the most significant story for investors was the dramatic and interesting rotation in the US market, which saw the Russell 2000 Smaller Companies Index soar over the course of the week, while some of the big tech companies sold off, Nvidia down 13% over a few days, for example. This could be the start of a more substantial rotation following the tech-dominated strong performance of the S&P 500 over the last couple of years. The technical factors of investors covering their shorts may also be a factor behind the scale of the move. In any event, the S&P 500 cap-weighted index was down by around 2%, but the equal-weighted index, which calculates the average of all the 500 stocks in the index rather than taking their market capitalization, was actually up 3% over the course of the week. So that was an indication of how dramatic this potential rotation could be. It wasn't a great week for equity markets in general. The FTSE was down 1.1%, although the oil share was actually one of the best performing markets around the world, falling just 0.25%. Elsewhere, the European markets were down even more than the S&P 500, and Japan was down even more than the European stocks. So not a good week for the equity markets in general. Over here in the UK, the gilts market also saw some interesting action, with about two-thirds of the gilts in issue seeing their prices decline, and around one-third seeing their prices rise. Mostly the shorter dated were the ones which saw the price rises, so suggestive of softer gilt yields at the short end of the curve. Most index-linked gilts were also up on the week, though, suggesting that lower inflation is beginning to have an impact as real yields decline. Investment Trust Index, meanwhile, was down 0.7%, so slightly worse than the FTSE All-Share, but that is a market cap-weighted index. And if you look in detail at the performance of the investment trust sector, I counted around 110 trusts showing positive gains on the week, and slightly more, 150 or so, showing declines. Not surprisingly, given what I've said, the list of gainers included a number of UK smaller cap companies which benefited from what appears to be a potentially significant trend towards small cap as opposed to large cap stocks. There's also some strong performances from Tufton Oceanic, the shipping company, on the back of its news that it is redeeming some capital. Also good performances from BioPharma Credit, following the news that it's now free to sort out the mess surrounding its one poorly performing debt counterparties. Also good performance from New Star, where John Duffield, the founder of Jupiter, is selling a chunk of his significant holding in the trust. On the downside, well, the tech stocks were prominent among the fallers, so Manchester and London, Polar Capital Technology, despite unveiling some terrific results this week, and Scottish Mortgage as well, also down. It was a poor week for commodities, and that was reflected in the negative performance of BlackRock World Mining, among others, plus some special situations relating to news on the week. There were not many results announced this week. Perhaps the two most significant were As I said, Polar Capital Technology, which produced, you can only say, excellent figures for the latest 12-month period, an NAV total return of more than 40%, which was actually a couple of points ahead of its technology benchmark. And the manager there, Ben Rogoff, as always, contributed a long and very interesting summary of developments in the tech space, explaining why he, for one, thinks that the AI revolution is here to stay. It's not a bubble in his view. And also we had some good results from Brunner, the Global Equity Trust, which reported a NAV total return of 12.8% for the latest 6-month period. That was a little bit behind its benchmark. We had some news also from others. There were quarterly trading updates from 3i. That saw its shares up again this week. And also PRS REIT, the build-to-rent property company. While Ruffer published its annual review ahead of its full annual report. And that showed that its NAV had increased by just 1% over the 12 months ended 30th of June. It's been a tough period for that particular trust, given its ambition to deliver positive absolute returns in every reporting year. Meanwhile, Odyssean announced it has raised $11.4 million in its placing and retail offer, and shareholders in Regional REIT approved the £110 million fundraising that is designed to repay its $50 million outstanding bond. But the shares of that one are still well down on their all-time highs. That's been a serious problem for investors, that one. And finally, we heard that the Board of Home REIT has decided that it's proposing to wind itself down, as it believes it'll be too small once it's finished disposing of the assets it's able to sell in order to pay off its loan to Scottish Widows to be viable. Scottish Widows has refused to renegotiate the debt that Home REIT has with that particular lender. So more on that in just a moment. I shall be discussing that with Andrew McHattie, along with most of the other news items of note this week. Finally, for those of you who are subscribers to the Moneymakers Circle, I would mention that our in-depth trust profile this week features Fidelity China Special Situations, ticker FCSS, the first of the big China trusts to come to market, originally set up by Anthony Bolton, and now at a very interesting juncture, I think. The Chinese market has been very weak, but is this a good moment to look at that market again? Well, our profile looks at that issue and at the trust's performance in great detail. Along with that, we have our usual summary of all the main share price, NAV and discount movements over the course of the week, and I've added some comments about one or two of the news items I'll be discussing shortly. Looking ahead, the podcast will be coming out as normal next week. I have an extended interview with the chairman of both Witten and Allianz Trust, whose merger was announced the other day, a very interesting development in the global sector. And beyond that, we will be taking a short holiday break. The podcast will not be coming out for 1 or 2 weeks, but you will continue to be able to see a summary of all the main news items and some commentary through the Moneymakers Circle during that particular period. So it's been a momentous week on the political sphere with the attempted assassination of Donald Trump last weekend and continued questions around the future of Joe Biden and whether he'll be standing against Trump in the November election. That's obviously a potentially significant development. But in the meantime, back in investment trust world, it's been a quiet week. The investment trust index is down around 0.7% on the week as we're talking on Friday lunchtime. But there's always some interesting news, and here to discuss that with me is Andrew McHattie, the editor of Investment Trust Newsletter, one of our regular contributors, man on top of the news. Before we talk about the markets, actually, Andrew, perhaps we should just start by going through some of these announcements this week. There have been some very interesting ones, and I guess we have to start with the latest annual results from Polar Capital Technology. It has been an extraordinary year for technology stocks. Interesting that this week they've sold off, but Polar Capital Technology has put in another outstanding performance, has it not?
Well, it has, Jonathan. I think it's a very timely moment to be speaking about this. As we're speaking on Friday lunchtime, we're, of course, surrounded by this terrible software outage that's happened this morning with the CrowdStrike cybersecurity software update that's gone awry and has thrown airports and banking and healthcare and shops into disarray. So that's a reminder, if we needed it, that technology is all around us all of the time. And it's a tremendously important aspect of modern life, so we can't ignore it even if we want to. But as investors, of course, you haven't wanted to ignore these big technology trusts, which have been fantastic performers of late. And with Polar Capital Technology, it announced its final results to the end of April with a net asset value total return of 41%, which is not only impressive in its own right in absolute terms, but it's also ahead of the benchmark, which was up 39%. And that's really not an easy benchmark to beat. So in this case, it very much helped that AI was heavily represented in the portfolio, with NVIDIA at 11% of assets, but actually a number of other chip makers and data centers and other stocks very much attuned to the rise of AI in the portfolio as well. So it's a really interesting one, actually. And if you have time, I really recommend that you read the manager's report that goes along with this. It's a tour de force every year. Ben Rogoff writes this quite lengthy essay, actually, on the state of the technology sector. And it's full of insight and intelligent information. A couple of things I picked out, just two things that I'll mention briefly. The first thing is that Ben says that valuations appear extended but not unreasonable. And I think that's a really key point, because I think many investors are somewhat put off now about investing in tech at this point or adding extra money to it because they worry about these extended US valuations. But perhaps actually in the context of the underlying growth of these companies, it's not unreasonable, not at bubble levels anyway. And I think the other thing I pick out from it is that Ben did talk about AI at length, actually, and says we expect AI to profoundly change the world. And of course, that begs the immediate question, Jonathan, doesn't it? Well, how is it going to do that? How is that going to be expressed, and how can I benefit from that? And the answer is that he doesn't know yet. And that's not a cop-out. That's just how history unfolds, actually. When there are great leaps and these major inventions, actually, the people who've made those inventions and those progressions don't understand at the time quite how it's going to be developed and how it's going to change the human existence, but it eventually does. So anyway, we'll have to see how it unfolds. But for the moment, this trust is doing very well.
Indeed, and I always read his annual report statement, and it is very comprehensive, as you said, a must read. I included a part of it in the Investment Trusts Handbook last year precisely because I thought it was so interesting on the subject of AI. And what I noticed this year was, obviously, it has been a year when AI has performed exceptionally well as a theme, but I also noticed that Ben Rogoff and his colleagues have been adopting a very high turnover rate, a significant turnover inside the trust this year, and including, as you say, bigger holdings in some of these big tech stocks, and benefited hugely from that, from making that was quite a big bet, because a year ago, as I recall, and you recall, everybody was still already talking about it being a bubble and it was all too early and you've got to look out and worry about the valuations and the concentration in the names. But in fact, we've had another standout year from NVIDIA and others, up more than 100% over the year. So they just go on going. It has to stop at some point. But I noticed also, the interesting thing about Ben is he always writes some interesting stuff about the macro environment as well. And he has some derivative positions in the trust in order to guard against some kind of macro event that would hit his technology holdings. And they made some losses on that, which is obviously a very wise and useful safeguard against something going wrong, but turned out to be okay. So I suppose the question is, how much longer can this go on? The shares are off this week. Obviously, we've seen a little bit of rotation out of the big tech stocks this week, and Polar Cap Technology is down about 7%, I think, this week on the news. Obviously, some profit-taking going on there, I would suggest. But how do you see the outlook for this one? It's in the right place for a strong secular theme, but it does seem as if there will come a point when the big tech stocks do derate or some of the bubble deflates. How do you see this one? If you're already a holder, you're going to carry on? Are you going to take a little bit of money off the table, or would you be keeping 100% position?
As usual, you've put your finger right on the button here, and this is the key question with which we're wrestling, I think, at the moment, and I'm asked about it a great deal. And I do find it very difficult to answer. I think it's tough actually to have a really defined, strong opinion on this because there are so many variables and you can be wrong so easily. So my sense is actually you shouldn't do anything too dramatic, that if you are a holder of Polar Cap Technology or one of the other technology trusts, then I think you probably should hold on to the majority of your shareholding. You might wish to trim it if it's done spectacularly well for you and redeploy those assets. And there is an argument actually that as economic conditions improve, so investors no longer need to take these more risky positions in pursuit of this very narrow amount of growth that we've had in the tech sector, and they can broaden out into better value stocks. So there is a risk, I think, of a derating, but nevertheless, I think if you don't have this exposure in your portfolio, then you're at risk of really missing out on some more excellent gains to come. So I think it's a balancing act, and you've just got to be sensible with your own portfolio and maintain a decent level of exposure, but you can trim it when it gets a bit too much.
Yes, I think the other thing I picked up from what his comment, he was talking about the outlook for the markets generally, and he said they appear fully valued if we think the timeline to AI's economic impact, because obviously at this stage we're still very much in the investment mode, is 5 years or more away, but it's much more reasonable if that timeline is sooner. And the shortening timeline to artificial general intelligence, the ability to understand, learn, and apply knowledge across a broad range of tasks and domains at a level comparable to human intelligence, presents a further upside scenario. So essentially, I think he's saying the same as you as far as he's concerned. Unless the impact of AI is quite a long way away, he thinks that there's still a lot to go for. I notice also that they're doing a 10-for-1 share split. I guess that's sort of sensible and routine housekeeping, if you like. Will perhaps give a potential to broaden the base. The shares trade at about £31, £32 at the moment, so that will make it slightly more accessible for those who like smaller lot investing. But the discount is still there, isn't it? It's still at around 7, 8, 9%. They've been buying back some shares, and that's historically been not a bad level for this particular trust, I think.
No, that's right. It's not bad value at all at the present time. Actually, very much on a par with Allianz Technology and Manchester and London as well. So it's not as though you're being asked to pay an unreasonable price here. So, yes, I think the discount is largely irrelevant, which is not something I say that often, actually. I generally believe the price you pay is highly important. But actually, in this case as well, if you're thinking of owning these shares for a long time, which I think is generally the best way to think about them, then your entry price, unless it's extreme in one direction or the other, shouldn't be that significant. But no, the valuation is quite reasonable, and there's no reason why, if you don't currently own it, why you shouldn't buy it. The only thing I would caution against is any expectation that you're going to make money over 3 months or 6 months, because you might not. You might find this is not a great entry point, but that's not really, I think, how you should be thinking about these shares.
Well, I guess we could then go to the other extreme, which also raises similar kind of portfolio management issues, and that is we had the Q2 update from 3i Group. It's in the private equity space, has a very distinctive strategy and a very highly concentrated portfolio, which is dominated by Action, this European retailer, which continues just to go from strength to strength. So what did you make of their results this week? And before we go on and talk about the rating on this one.
Yes, it's a peculiar one, this one. And 3i is sometimes thought of as being an investment company and sometimes not, because it's maybe a private equity investor. And also it does have this extraordinarily concentrated portfolio now, because actually 72% of its assets are in this one company, Action. And that's partly because it's been so tremendously successful. It's a Dutch-based discount retailer with about 3,000 stores. It says it services about 17 million customers. So although here in the UK you might not have heard of it, it's actually a big company and doing tremendously well. And that's the key here, that it's been a great investment for 3i, carries on being a good investment. And actually, when I read the analysis from stockbrokers who look at these quarterly results, they're generally not so focused on the investment trust itself, but they're focused quite reasonably, given that concentration, on Action and its performance, its balance sheet, its EBITDA. And that all looks very strong, I have to say.
It has been an extraordinary phenomenon. I looked up the share price earlier this morning and, 10 years ago it was at £4 and now it's at somewhere over, say, £31 to £32. So that's been an extraordinary gain over that period. The greater part of it's been concentrated in the last couple of years, where the shares have basically tripled in a little over 2 years. So it is an extraordinary thing. And of course, the reason for that is that the shares have gone to this extraordinary premium to NAV. It depends who you look at, but say 45% or getting on for 50%, which is an extraordinary thing. And not normally a recipe for good future returns, but this is a very special case, is it not? So if you had taken some people's advice to trim your holding last year, because it was still on a very substantial premium, you would have missed out on some further gains. But on the whole, it remains good practice to take a little bit of money off the table when you see these shares trading at such a large premium. We've seen many examples of that over the years. I think you would agree.
It looks utterly bizarre. I mean, it really does, doesn't it? Against the private equity sector, which we've been talking about for ages as being on a very wide discount generally. And there are many good value trusts there on 30 or 40% discounts. And then you have 3i on this 40% plus premium, which just seems to be an enormous outlier. And I think that does place it very much in the high risk category. And it's a high risk, high growth, high potential return situation. And I think the analysis I've read is that it's all predicated on the fast growth at Action continuing. And the forecasts do look very strong. And so if that plays out as forecasts, then the valuation should grow into the share price and you should be all right. But nevertheless, it does look quite risky at this point. So I think you have to bear that in mind and place it in the high risk bucket. And if because of its growth, you found that's a growing percentage of your portfolio, then again, trimming the position rather than selling it outright might be a sensible approach.
Yes, and the market cap of this one has reached about 29 billion. So it is by far the largest investment trust by market capitalization. Nothing to say you can't go higher than that, but it's becoming a very, very chunky animal. And that valuation, if you include it in the performance of investment trusts, it does distort the results quite significantly. So there we've had two extraordinarily good stories. We didn't actually say what the Q2 update did in terms of performance. Can you remind us of that?
It wasn't anything too dramatic, actually. So taking the 30th of June NAV, it was up 4% over the quarter. So not very dramatic, and then perhaps if you look at that figure, it maybe doesn't justify that enormous premium, does it? But that's part of the general growth that's been occurring here, and it's obviously a smooth growth trajectory that's been enjoyed by 3i for quite some time here.
Okay, so let's move on and talk about a couple of equity raises, very different contexts though. The first of these came from Odyssean Investment Trust, which is a UK small cap specialist in the Harwood Capital stable. We haven't seen very little issuance of shares in the last couple of years, apart from some persistent issuers who've been able to take advantage of trading at a premium, and Odyssean is one of them. But it's raised a slightly bigger chunk this time. Tell us about that, what the details of this one are.
Yes, that's right, Jonathan. Effectively here, an investor approached Odyssean and said it wanted to put some money in, and it was unable to do that through the market because the shares are not that liquid. And so the company decided on a placing together with a retail offer, just tagging along with that. And they raised a total of £11.4 million from that at 174 pence, which was at a 1% premium to NAV. And this is an interesting trust because it does trade on this premium rating. It's had a good track record and it's on a 1.7% premium today, I think. And I think one interesting angle on this is that it's one of three smaller company trusts in the Harwood stable with three different managers, but actually quite a lot of overlap, and these three managers do work together. And I think it's reasonable, therefore, to look at all three. And one of the others is also well known to us, Rockwood Strategic, also on a premium rating, about 3.5%. And that leaves number three, which is a completely different animal, and that is Oryx International Growth. Now, the name of that doesn't suggest it's a UK smaller companies trust, but it actually is. It's a UK special situations trust managed by Christopher Mills. And that trust does have a considerable overlap with the other two. It probably sits in between them. Last time I spoke to Chris Mills, he explained that probably Odyssean is at the top end of the market cap spectrum in regard to UK small caps. Rockwood towards the bottom, and then Oryx sits somewhere in the middle. But the interesting point about this one, Jonathan, is that it's on a 25.8% discount, which is a tremendous contrast to the other two. And there is a reason for that, because Harwood, their managers, own more than 50% of the trust. So they have a controlling stake. So there's no chance of any corporate action there. And your power as an individual shareholder is quite limited. But nevertheless, that's a very significant divergence in the rating there.
Right, and I think the issues for Odyssean is it's about 215 million market cap. It would like to grow a little bit more. It sees that its kind of investments there is room to grow. It can still get bigger without actually losing its ability to invest fully. Whereas Rockwood Strategic is market cap of about 87 million. That's quite a bit smaller, but it is in the microcap thing, so liquidity is an issue. But you're suggesting that maybe it's worth having another look at Oryx. Is that what you're suggesting?
Well, yes, that is what I'm suggesting, because I think actually if you look at the track records, they all blow a little hot and cold because, of course, they all have individual holdings that are not necessarily in common. So one will outperform the other at any given moment. And Oryx maybe hasn't been quite as exciting as the other two in the short term. But over the long run, it does have a tremendously strong track record. If you look at the 10-year track record here, it's really very good indeed. And Christopher Mills certainly knows what he's doing in that sector. So, yes, I think it's well worth a look. Again, it's not something I would recommend as a short-term investment because it's not the most liquid trust and the dealing spread is a little bit wide. So, again, I think it's something that you can put into your portfolio and leave for a while, and then the dealing spread is not so important. But anyway, it's an interesting thing to have a look at. Maybe something that's generally overlooked, that one, I think.
Yes, for the reasons you've given, and it has been quite volatile in the sense it had a very strong year in that remarkable period after the pandemic and then derated significantly. And now it's still trading, as you say, at a relatively wide level. But interesting, I think UK small cap's a very interesting place at the moment. Let's move on then and talk about another relatively small trust, or at least become quite small, which has also done an equity raise this week, but that's for an entirely different reason, and that's Regional REIT, which, as its name suggests, it specialises in regional commercial property, in particular in offices, which have not been a good place to be. And it's basically been forced to do a rescue rights issue because its balance sheet is, I don't know how to put this politely, kind of up the spout, I suppose I'd say. So tell us what they've done and how much money they've raised and what the background of this one is.
Yeah, it's quite rare in our sector to have any rights issues. That's not a normal thing for an investment trust to do. But obviously with alternative asset trusts, it's somewhat different because they own lumpy assets and they can't necessarily sell them to rebalance their portfolios and their balance sheets. And of course, debt has become considerably more expensive and a bit more scarce. And so you cannot necessarily refinance on good terms. And Regional REIT had a £50 million bond that was maturing in August, and so it had to try to think about what to do about that. It realised it wasn't going to be able to refinance at a sensible rate of interest, and so it decided it needed to raise some equity capital, and it went down the underwritten equity raise route, which meant it was able to raise £110.5 million, so quite a significant sum of money. And it was asking shareholders to stump up this money through a 15-for-7 rights issue. And that was requiring them to actually raise quite a bit of cash, which not everybody had. So it was underwritten by a company called Bridgemere, which is owned by Steve Morgan, who founded Redrow, the builders. But anyway, this morning we had the result of the issue, and it was taken up to the tune of 72.6% by existing shareholders, which was the rational thing to do. I advise my subscribers who had shareholdings to take up the rights. Effectively, otherwise, you're just suffering dilution and transferring some of your money over to Bridgemere. So it made sense to take it up, but of course, not everyone had the cash to do so. But the interesting situation now is that whilst the trust has rectified its debt position and now has working capital to spend on necessary capex on its buildings, that's all good news. Interestingly, though, Bridgemere now has this 18.7% stake in the shares, and it'll be interesting to see if they just are content to sit and hold that, or whether down the line, in a year or two, perhaps there's a bit more corporate activity to come.
Yes, I think it's fair to make the point that this was a deeply discounted rights issue, at least if you compare it to the stated NAV. It was done at around 10p or something like that. And the shares now have edged back up to 13p, which reflects, I think, the fact that it's not going bust anyway, which is something that has got some sort of future. But it's be interesting, as you say, to see what Red Rose, a house builder, wants to do with the commercial property trust. I guess they see some value in that, some sort of business rationale for that. And, the shares are down. They were trading at over £1, 120p, I think, only 4 years ago before the pandemic. But it's been one-way traffic almost all the way for the last 3 years. The share price has obviously been falling very sharply as investors came round to realise that the balance sheet was all over the place and it wasn't going to survive unless it could raise more equity. So we don't expect to see many more of those rights issues, I don't think. The normal solution in this sector is for mergers or takeovers to sort this out. But it does highlight the problem of companies that get into trouble because they've got too much debt. And I think that gives us a good way to lead into another story that we really don't want to mention, but we feel we have to, which is the continuing unfolding disaster that is Home REIT. I'll ask you to summarise what we know now, but basically the board has had to concede that there's no way through for this particular trust to survive. And that's largely because the lenders to the trust, Scottish Widows, have basically pulled up the drawbridge effectively and said they want their money back and they're not interested in refinancing. So perhaps you could fill us in on the not so pretty background to this one.
No, that's exactly right, Jonathan. And this has been the greatest disaster, I think, in the sector over the last few years. It's a terrible story for anyone who has been unfortunate enough to be a shareholder in Home REIT. We saw its shares suspended in January 2023, so it's a very long time ago. So you've been stuck in this investment that whole time, not even able to sell out and get a small proportion of your money back. And now, as you rightly say, the board has decided that it doesn't have any further options available to it. It cannot reconfigure its portfolio and get back on a reasonable footing. So it's proposing a managed wind down, which is largely because it has to repay that debt to Scottish Widows by the end of this calendar year, which means it's got to actually press the accelerator pedal here and start shifting some of these assets quite rapidly, possibly not at very good prices as a result. Nevertheless, there may finally be some small rays of light for shareholders, not very much. It's a pretty gloomy place they're in here. The first piece of modestly good news is that finally all of the delayed accounts might finally be published in the third quarter. And we've been thinking this for a while, actually. It's been delayed and delayed, which will at least allow the share listing to be restored. So potentially you can sell out. But I don't think it's going to be much of a price available for shareholders. And the news here is pretty grim on the potential returns, because even in this managed wind down, which may take a while given that the quality of the properties in the portfolio is obviously quite low, even when the money comes back, though, the actual returns to shareholders are going to be delayed here because the company itself needs to hang on to that cash, because it's engaged, of course, with litigation and investigation. So it's not able to give that money back to shareholders straight away anyway. So all in all, it's a very grim position, and it's not going to reach a conclusion very quickly, I don't think.
Yes, and as you mentioned, there is this backcloth now of lawyers getting involved. The company is suing the Alvarium who were involved in setting this thing up. And the shareholders are threatening to sue the company as well for mismanagement or whatever their particular case is. So, as you say, they're going to go into a managed wind down where they're going to try and sell as much as they can, particularly of the homeless properties. They have been selling a lot already, but at very big discounts to their stated value. And so when the results do come out, and we're still waiting for the 2022 results, it should be mentioned, there's going to be massive write-downs. And as you say, the question will be if there any residual value there when the dust settles. It's not been a great story. The FCA is looking at this, and there's possibly a criminal investigation, we don't know yet, about what actually happened and why this went so wrong. But it is, as you say, a bit of a blot on the landscape. But hopefully it's now at least approaching the end game, and we won't have to talk about it much longer, which would be a very good thing, I'd have to say. Moving on, 3 more events we want to cover. Let's start with Tufton Oceanic, one of the 2 shipping trusts that have come back to the market in recent years. Tell us what they're doing. They're making a partial return of capital, but you can perhaps fill us in on the details of this one, Andrew.
This was flagged in advance, so it's not a surprise, but it's good that it's come to fruition now. Yes, the trust effectively raised some cash back in January when it sold 2 large tankers, and it had this excess cash on its balance sheet. So it's now returning $31.5 million to shareholders through a compulsory redemption of shares. Now, this is not that dramatic because it's only just under 7% of the equity, but the shares are being redeemed at the latest NAV, which is $1.55, which is considerably above the share price, although that has been rising. It's up to about $1.29, I think, today. And so this is good news for shareholders. You get a bit of an uplift. And generally, actually, this trust has been performing really very well of late. I remember, actually, not that long ago, these shares were on a discount as wide as 33%. I mean, this was within the last 12 months. And that's come right in now to about 16%. And to my mind, this is a very good example, actually, of the investment trust sector getting its house in order, realising value, returning it to shareholders, improving the discount, and everybody wins. So this is a good news story, which is a great contrast to what we've just been talking about.
Yes, and there's obviously another significant player in this field, which is Taylor Maritime Investments. That's ticker TMI. That has a slightly bigger asset base, but that trades still on quite a big discount. But both of these trusts, I think, if you look back to their launch, they are improving. The total return, at least, has been reasonably significant. And looking at Tufton Oceanic, that's delivered a total return around 70% over 7 years, which is not great, but it's not nothing. What's your thinking about Taylor Maritime? Do you have a view on that one as well?
I actually own both of these, and I do think actually they're both very good trusts, because the idea of them was that they provide some diversification to your portfolio and benefit from a cyclical low in the price of ships. And that actually generally has played out, and they're giving you a very nice dividend yield while you wait for this discount to narrow as well. So all in all, I think it's a good proposition. It's not quite the attractive proposition it was a few months ago when you could buy them on these mammoth discounts, but nevertheless, there's still value there, so I'm not in any rush to sell out. One thing you should bear in mind is that they're dollar denominated, and so you're taking a little bit of a currency risk, and these are not mainstream investment trust investments, so you don't have to own them in your portfolio, but I do think they're interesting, actually, and I'm quite glad they exist. They might not be around forever, and Tufton has already said that it's planning to start a wind-down procedure from 2028 onwards, because that's really marking the fact that these trusts did spring up quite specifically to benefit from this cyclical low point in the price of ships, and that's not going to last forever. So these are not these long-term holdings we generally talk about, but they're interesting at the moment.
So that's an unusual approach by the board there, or by the promoters as well at the outset, to put a time limit on it. That's certainly interesting. Let's talk next about Gore Street Energy Storage. That's one of the battery storage trusts which have had a pretty torrid year on the whole so far. What's the update from Gore Street?
This is a sector we've talked about quite a lot, and the battery storage sector has had tough times because of the much lower than forecast revenue from GB assets, which has really caused a big problem for two of the three players in the sector, so Gresham House Energy Storage and Harmony Energy Income Trust, both of which had to suspend their dividend payments or stop their dividend payments, whereas the third player, Gore Street Energy, was able to maintain its dividend because it had very good performing assets in places like the US and Germany and in Ireland as well, and a much lower proportion in the GB assets. So it was able to maintain its dividend, but with its results to the year to the end of March, it's given up a little bit of that moral high ground, and it said it's planning to aim now for a rebased dividend of 7p for the next financial year, which is slightly down on 7.5p that it paid in the year just gone. And this is because it says it wants to more closely align its dividend with its operational and other cash flows. And there's a bit more to this than meets the eye, actually, because a reduction from 7.5p to 7p to a more covered dividend just seems to make sense and doesn't seem like a very big deal at all. But it's also shifting, actually, the quantum it's paying in the first 3 quarters of its financial year, and then the balancing payment in the final quarter. So it's only going to pay 1p a share for those first 3 quarters, and is aiming for a much bigger dividend of 4p in the last quarter. And that's okay if it comes off. But there's a bit of scepticism about that. I think some brokers feel that this structure is giving the trust a bit of wiggle room to maybe reduce that final dividend if the operational cash flows don't come in quite as forecast. And they're not entirely within the trust's own control because it includes investment tax credits from the US, and it does depend a bit on the build out of the portfolio, which can always be delayed. And also, of course, there's the likely path of the power revenues, which are, again, slightly uncertain. We don't know whether the US revenues will come in strongly this summer as they did last year. So there's a few uncertainties here, which is, I think, why the shares did suffer a bit on this announcement.
Yes, I see that they're down around 9% this week, which is probably not quite the reaction they were hoping for. It always makes me chuckle when people talk about rebasing the dividend, because that's a very polite way of saying we're going to cut it by some degree, even if it's only a small amount. The discount of this one remains more than 40%. So it's sort of come into line with the other two battery storage trusts. Obviously, we know that battery storage is going to be an important part of the path to net zero, but the way that it's been implemented so far in the UK has been pretty uninspiring. We don't have the infrastructure in place. The national grid is not set up to make connections quickly at the moment, and so there's a lot of work to do there. But you would think that this might be an area where the new government will be taking a look if they want to carry on with their net zero campaign. This should be a good area to invest in, perhaps, or at least to prod National Grid into doing something. So are you personally of the view that there's mileage in the battery storage trusts? And if so, would Gore Street be the one you would hang on to? I know you own one of these, at least, don't you, Andrew?
Yeah, that is true. Yes, I mean, I do think this is an area of focus for the new Labour government, and that might be a good thing, although not necessarily so, because, of course, if it attracts too much capital into the sector, then it could eventually undermine these current players. But these are important trusts, actually, and we do need to have this balancing mechanism available. And so I do think that fundamentally the National Grid will sort out its allocation and its allowances for these trusts, and that their revenues will pick up. Because I do think they do have a future as part of our important renewable energy sector. And on that basis, actually, the fact that they're really unloved and shunned at the moment on these mammoth discounts of 40% plus, I think does yield an opportunity. And it partly depends on how much risk you want to take here. I think at the very high risk end, you've got Harmony Energy Income Trust, which is possibly the most risky of the three. But equally, the board has said there's quite a lot of interest in third parties potentially buying some or indeed all of the assets of that trust. So takeover is a potential outcome there. And I think on the current discounts, it might be worth taking a bit of a speculative position in that one. I think of the other two, actually, Gore Street is my preferred one over Gresham House Energy Storage because of the geographical diversion of assets, which seems to make good sense. Actually, it's doing very well from its German and US assets in particular. Ireland is okay. It's better than the GB assets at the moment. And so I do feel, actually, that everything it's doing at the moment makes good sense. And to my mind, there is excessive scepticism about the path forward and also about this new dividend structure. So I've just added to my position in that one. So there we are. That summarises my view.
Okay, well, 7p and the shares are trading at about 61p, I think. So if they can deliver, then that's going to be a significant yield with some potential upside. But I guess, as you've implied, the market is often sceptical and may wait until they actually find out for sure what the dividend position is. I think that would be the kind of cautionary tale. Let's move on and talk about Chrysalis, another very popular with retail investor investment trust in the growth capital space, and very much, therefore, in the kind of eye of the storm as far as the derating of that sector has been over the last couple of years. Shares came down a long way, and they have recovered a little bit. Tell us what the latest there is.
It's a volatile stock, this one, with volatile news flow as well. Again, somewhat unloved at the moment, but there's been some good news with the sale of Graphcore, which was one of its significant holdings. That company's been sold to SoftBank, and as a result, this trust and also Schroder British Opportunities, actually, that had a holding as well. They both enjoyed an uplift to NAV. In neither case was it that significant, and also in neither case was it a successful investment. So Chrysalis didn't actually get all of its money back here. But nevertheless, the important thing is that the sale went through at a time when, of course, there had been something of a logjam and a difficulty in realising assets. And it did go through at a premium to the last price in the books. So it was good news for Chrysalis. And the other important aspect of this is that Chrysalis now has a nice cash buffer. So the trust said it was going to need a cash buffer of about £50 million, and that realisations beyond that level would mean that it would then deploy cash towards share buybacks and to other returns of capital to shareholders. So the progress here is that the cash buffer basically has now been achieved. So the next realisation that occurs will presumably allow the trust to begin share buybacks, possibly on a significant scale, Jonathan. And I think at that point we could see that discount really shift quite rapidly. So again, to my mind here, the current position looks very speculative. This is a trust that has a lot of uncertainties. The recent track record is poor. There's a lot of reasons not to own it. But if you are a high-risk investor and you're prepared to look at things that maybe may take a little while to play out, then again, I think there's some good latent value here.
So they're still trading on a discount south of 40% and have been on a rollercoaster ride, as we said. I guess the final point to make here is that, of course, Graphcore was at one point described as the UK's Nvidia because it's in the chip business, but that's failed in that sense, and the company is being sold with the government approval to SoftBank, which is the Japanese significant investor in tech stocks. So I guess that's also a bit of a warning that not everybody in the AI space can win. And when we see technology bubbles, that's what happens. We see a lot of stocks go up because they're associated with an exciting trend. But it does remind us that not everybody can be a winner. And unfortunately, the UK's Nvidia has, well, we'll see what it does. Maybe it will prosper and come back and challenge Nvidia now under Japanese ownership. We shall see. So on a final point, perhaps, Andrew, here we are. We're approaching the August holiday period, the dog days of August, but we've got a new government and we're looking forward to a new autumn statement or mini budget or whatever you like to call it, coming up in a couple of months. Labour Party's talked about a lot of things, but we haven't really seen the detail. We don't really know how they're going to make these things work. And we don't know yet whether the Bank of England is going to be cutting interest rates imminently. Latest inflation figures not particularly encouraging on that score that came out this week. So I guess to some extent we're still in waiting mode as far as the investment trust sector is concerned. We're all looking for derating to come to an end. It has come a little bit better. We're averaging around just over 13% now, I think, from a peak of 19 on average across the sector. But this year hasn't been quite as positive, but you're holding out hopes for the autumn.
Yes, I mean, it's an interesting period, this, and I think we are having a little bit of a lull, aren't we? But I think what's happening now is that many of the initiatives that were announced in the investment trust sector in the spring are now coming through. So it takes a while for things like buybacks and return of capital to shareholders and asset sales to actually come to fruition. But we're now seeing some of that money flowing back into broking accounts and being reinvested. And so I think that's quite positive. Actually, it's all part of the recycling of capital and the reinvention of the investment trust sector that we've talked about quite a lot, and hopefully bringing it to a more healthy position going forward. But I still think actually markets broadly are still going to be driven by interest rates. And we're still waiting for this much anticipated interest rate cut that we've been putting off. And it's moved from May to June and July and August. And now we're thinking maybe the autumn. And it seems to me from recent economic data that we might get a cut actually in the US quite soon because inflation is looking good there. In the UK, though, services inflation is still a bit high. And I was quite amused, actually, when I saw the quite poor figures for the June retail sales, which again pushed out the likelihood of an interest rate cut. They were blamed on bad weather, Jonathan, which is always a tremendous excuse in these matters. You can blame the weather when it's too hot. You can blame it when it's too wet. You can blame it when it's too cold. Ultimately, it just means actually the economy is not performing quite as strongly as we might have hoped. So I don't know whether those interest rate cuts are going to come through in the autumn, perhaps around budget time if the new Chancellor is fortunate. And that might stimulate actually quite a significant increase in demand for investment trusts when it comes through, because there's a significant sensitivity both amongst the high yield stocks and amongst the growth stocks. So we'll have to wait and see, as always.
I guess my only comment on that is I think it's not a particular surprise to me that we've had to wait so long for interest rate cuts to materialise. It's a great sales point for anybody who's involved in having to sell investments. But, what we can say, I think, because the discounts are still quite wide on average, is that not everybody is already anticipating these interest rate cuts by buying ahead of the news. So I think from my personal perspective, we need to be a little bit cautious about that. Gilt yields at the short end are still pretty high. So you could make a scenario that basically they're not going to come down that much that quickly. But who knows? The US economy is slowing. The global economy is slowing a little bit. So we don't know. As always, when it comes to the macroeconomic, we don't know. We just stick to talking about the stocks and hoping that our investments do better than average and deliver us returns over the medium-longer term.
That's exactly right.
So thank you, Andrew. That was Andrew McHattie, the editor of the Investment Trust newsletter, talking to me this week about some of the latest announcements from the Investment Trust universe.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.